Good evening, students. I hope you have revised whatever we have done in the last class. So we had covered already now the concept of residential status thoroughly, dealing with individual residency as well as company residency. In the last class, we focused more towards the residency of companies. A company is said to be resident in India when it's an Indian company or place of effective management is situated in India. What is place of effective management? Place where key management and commercial decisions are in substance made. For determining that, CBDT has given us guidelines. What does these guidelines say? That active business outside India. If a company fulfills the active business outside India test, then the poem is presumed to be outside India if majority of the board meetings are held outside India. Exception to that is if the decisions are taken by the Indian parent or Indian resident, then poem will be in India. If ABOI is not fulfilled, then in that case, you need to determine two things. Who is taking decisions and where those decisions are being taken up. Correct? So, for determining that, you have separate set of guidelines. Who is taking the decision, whether the board of directors, whether shareholders, whether the keys or key financial advisors, who is taking up the decisions. And based on that, where those decisions are being taken up, that will be poem. Correct? How do you determine ABOI? Passive income be less than or equal to 50% of total income. What is passive income? Dividend, interest, royalties, FTS, and what? Purchase and sale of goods to or from A. The income from that would be considered as passive income. Correct? 50% of total assets should be in India. 50% of employees, less than 50% of employees should be in India. Less than 50% of payroll expenditure on those employees should be from India. In that case, if all the tests are cumulatively fulfilled, active business is said to be outside India. Correct? Then we saw there was a transition mechanism being specified. What was the transition mechanism? That if a company becomes resident in India by virtue of poem for the very first time, then you will have to take into consideration the WDV, the brought forward losses, the unabsorbed depreciation as per their tax records, if they are maintaining the tax records. If there is no requirement, if that company is not taxable in that country, then as per the law of that country. Then the balance sheet and P&L is for the extended period if it is less than 3 months. If it is more than 3 months, then in that case, what you have to do is you have to, if it's less than 6 months, if it is more than 6 months, then what you have to do is you have to break it down into 2 periods. Clear? Then we saw the provisions applicable to foreign company would prevail over the provisions that are generally applicable to Indian resident. So TDS under section 195 would continue to apply to a foreign company who has become Indian resident. 40% tax rate would continue to apply. Transfer pricing would continue to apply. So we had seen this kind of transition mechanism, which is given under a separate notification by CBDT. Clear? We had already covered in the very first class individual residency. What are the criteria? 182 days or 60 days and 365 days in last 4 years. There's an exception to 60-day rule. What is that exception? For person going out for employment outside India, we have to take 182 days. Or as a member of crew of Indian ship, we have to take only 182 days. Clear? If a person who is coming on visit to India, who has been always outside India and is coming on visit to India, Indian citizen or PIO, having total income less than 15 lakh, then 120 days. Clear? 120 days in the current year and 365 days in last 4 years. That will be the condition. Clear? Having total income more than 15 lakh. If it is less than 50 lakh, then you have 182 day criteria only. Clear? If a person is not liable to tax in any other country and having total income more than 15 lakh, then in that case, what will happen is he will be considered as deemed resident in India. Clear? What are the conditions for ROR and RNOR? ROR, if a person is resident in India for 2 out of 10 previous year and he is present for 730 days or more in last 7 preceding previous year. This ROR RNOR condition will apply only to the normal residents, the category 1, that is a person who is going outside India for employment, a person having total income less than 15 lakh coming on a visit to India, it will apply only to them. For a person having total income more than 15 lakh, if he is coming on visit to India, he will be RNOR provided he stays for more than 120 but less than 182 days. And a deemed resident will always be RNOR. Clear? So I've revised very quickly all of the concepts. If you have any doubt, you can ask me or we shall proceed further to the next part of this particular chapter. Any doubts? Which illustration 5 you are asking, Raghuram? Okay, so I'll proceed further now. One second. Okay. So in today's class, what we would be covering is, we would be starting up with income deemed to accrue or arise in India. So let's begin with that, which is section 9. Income deemed to accrue or arise in India. Now again, this is very important section 9, which is basically saying us that when can we say that income is said to be deemed to accrue or arise in India. Just one second. Yes. So when do we say that income is deemed to accrue or arise in India? So generally, whenever the income is sourced in India, we say that the income is accruing in India. Say for example, we have been making certain payments from India, or the business is carried on in India, then we say that the income is generally sourced from India. But in some cases, even if it is not sourced from India, section 9 creates a link for non-residents and it says that even if it is not directly accruing from India, it will be deemed to accrue or arise in India. Are you clear? So what happens is, understand this one thing very clearly. For residents, as I said, global income is liable to be taxed. We discussed this while we were discussing section 5 for ROR. For RNOR, only the Indian sourced income is taxable, except in the case of business or profession carried out outside India, but is controlled from India, right? For RNOR. But this is a kind of exemption given to RNOR because in the very first, it should not be put into hardship of taxing the global income. Correct? So they are given some breathing period. That's why they are called as RNOR. Now, the third category, non-resident. For them, only the Indian sourced income will be taxable for a non-resident. So, Indian sourced income means income which is accruing in India or income which is deemed to accrue or arise in India or income received in India. Clear? Or income received in India. Right? So in that particular case, what will happen? We have income accruing, deemed to accrue, and received in India. These three income are taxable for a non-resident. Clear? There was one exception in case of receipt of income, which is not taxable for a non-resident. We discussed that in the last class. What was that? In case of a non-resident seafarer, his salary credited to Indian account would not be considered in total income if it is in respect of services rendered outside India. That was the only exception given to the non-resident in terms of received in India. Are you clear? Now we are capturing this thing deemed to accrue or arise in India, which is dealt by section 9. Okay. So now first we will be dealing with section 911. So let's understand what the section 911 says. Section 911 says income deemed to accrue or arise in India. It talks about income which is deemed to accrue or arise in India from business connection in India. Second, asset located in India. Property situated in India. Source of income in India. Transfer of capital asset situated in India. Now, what is the difference between accrual and deemed accrual? So say for example, if I say there is a property in India. Okay, there is my property in India. But I have been non-resident since very long time. Now, I come on few days in India and I stay in that property. But very recently I got so busy that I felt I don't have any more time. I cannot come to India, especially due to COVID. I cannot anymore visit to India. I am staying in US. So what will happen is, I find a person, say in US, who needs a property in India. Okay, who needs a property in India on rent. He has a son in Mumbai and he wants to take that property on rent for him. Now, I enter into the contract outside India for rental, right, with that another non-resident. But the property was always in Mumbai. I give it on rent. He pays me in dollars only there. And his son uses the property in India. So in that case, income directly does not accrue in India. Because where the accrual is happening is where the place where the contract is entered into. Is the contract entered into India? Answer is no. Where the contract is entered into? In US. Right? So though the property is in India, but where it is getting accrued, where the contract is being signed into. So it is US. But section 911 says, if it is from property located in India, income would be deemed to accrue or arise in India. Are you understanding the difference now? So what does section 911 says? It deems to accrue or arise in India, even if it is not directly accruing or arising in India. It says the income would be deemed to accrue or arise in India if it is derived from asset located in India, if it is from a property located in India, if the source of income is in India, or if it is from transfer of capital assets situated in India. So, what do we mean? First, keep aside business connection. I will deal with business connection separately. First, I am touching upon the other points. Derived from asset located in India. What do I mean by that? Derived from asset located in India. That, say for example, I am receiving dividends from shares of Indian company. That is income deemed to accrue or arise in India. Even if it is received outside India, it is income deemed to accrue or arise in India. It is from asset located in India. From a property located in India, right? As I give you the rental example. Source of income is in India. I am generating some interest on bank deposits. The source of income lies in India. It will be income deemed to accrue or arise in India. Clear? Transfer of capital assets situated in India. If I sell off my any Indian asset, in that particular case, if an asset is located in India, capital asset, and if I sell off that asset, even if I enter into contract for the sale of asset outside India with another non-resident, that will be still taxable in India because it is said to be income deemed to accrue or arise in India. Are you clear? Clear up till now? Now, coming to a very, very important term, business connection. What do I mean by the term business connection? Now, Section 911 does not define what is business connection, but it gives some inclusions that what is included under the term business connection. This is a very wide term. Business connection is a very, very wide term. So, what does it say? What is included under the term business connection? There are certain inclusions provided and there are certain exclusions granted. Okay. So, what are the inclusions? Dependent agent. We will deal with the definition of dependent agent. And it includes significant economic presence. What are the exclusions that I'll deal separately? Clear? So, if you see, I have prepared here the chart. It includes the dependent agent and the significant economic presence. Okay? So, first of all, let me explain you what is dependent agent and what is exactly the term business connection. So, business connection means that if, say for example, a non-resident comes to India for purpose of doing any business in India, right? He comes on doing a trade in India. He comes on doing or carrying on a profession in India. In that case, he will fall under this limb of income deemed to accrue or arise in India. Why do I say that? Because he is having some connection with the Indian land by carrying on his business. He is utilizing the resources of India. He is carrying on certain economic activity in India, and therefore he is having some connection with Indian land. Clear? Therefore, India will say that we will tax you on that business income. That is how the term business connection has come into picture, right? So business connection is a very, very wide term. Business connection is a very wide term. It just defines what is included and what is excluded. It doesn't define what is the meaning of the term business connection. So it can include all of the business income which is being generated in India. But Now what will happen is, say for example, a non-resident is coming and he's just making sales in India, right? He's just selling his goods. The manufacturing of goods would have taken place in, say, US. Now, it will be very much incorrect if you see, if I will tax the entire sale income in India. Why? Why it will be incorrect if I tax entire sales income in India? Reason because sale is not only the result of the market country, the sale is not only the result of only Indian jurisdiction, right? There has been also an effort of manufacturing into that, right? There has also been an effort of distribution activity being there, because if there was no manufacturing, there would not have been any sale. If there would not have been any marketing activity or distribution activity, there would not have been any sale. So all of the income is not attributable to India, where the customers are located, right? So therefore, the income is taxed in all the jurisdiction. India will only be able to tax the income based on the income attributable to the functions carried out in India. Are you getting that? So it will not be entirely the 100 rupees. Say a product is sold at 100 rupees, that entire 100 rupees will not be taxed in India, right? Only the part of 100 rupees which is attributable to the functions carried out in India, because 100 rupees is attributable to all different functions, say manufacturing, the sales and distribution, the marketing activities, and all these functions may have been carried out in different countries, right? So in that particular case, India can only tax the income which is attributable to Indian operations. Are you clear up till now? Are you clear? So now business connection, as I said, has certain inclusions and certain exclusions. What are these inclusions and exclusions? So inclusion, as I said, it includes dependent agent. Now what is dependent agent? Say for example, I am not carrying on the business myself. As in, I am carrying on the business myself, but I cannot come and trade myself. I cannot open a store here myself because I do not know much about Indian jurisdiction, but I want to do sales here. So I will hire a local person in India who is aware about the operations in India, who is very well aware about the Indian market, the demand conditions, and he will help me achieving the sales target in India. So I will hire an agent in India, right? Now, this agent is working on my behalf. So, though I am not directly carrying on the trade in India, but I am carrying on the trade through an agent in India. In that case, if the agent is dependent wholly on me, in that case, he will be considered as my business connection in India. Are you clear? Now, who is a dependent agent? Section 9 provides a definition. So what are the conditions for dependent agency? Let's see it. Habitually plays the principal role leading to conclusion of contracts by a non-resident. Habitually plays the principal role leading to conclusion of contract by a non-resident, or has and habitually exercises authority to conclude the contracts on behalf of non-resident. Second, has no such authority but habitually maintains in India a stock of goods from which he regularly delivers goods on behalf of non-resident. And third, habitually secures the orders mainly or wholly for non-resident. Now, what does this mean? Who is a dependent agent? One who has an authority. Who has an authority? If a non-resident is giving him all the authority, that look, you have all the authority, he appoints him as dependent agent and he exercises that authority habitually. Habitually meaning regularly. So it doesn't matter that if he has the authority but he doesn't exercise it. He has to exercise that authority also. So if he habitually exercises the authority and he goes to the customer and conclude the contracts on behalf of a non-resident, right? So he has the authority and he habitually exercises that authority also, and he goes to the customer. He goes to the customer, decides the price, finalize everything and sell the goods and services. Conclude the contracts. In that case, that agent would constitute the business connection for non-resident. Clear? Or he does not have the authority to conclude the contract, but he plays the principal role leading to conclusion of contract. What do I mean by that? So this has been a recent introduction to section 911 in 2017. Why this has been introduced? This has been introduced because based on only these wordings, right? Here it says that the agent should have the authority to conclude the contract. But some of the non-residents try to deliberately circumvent this provision by not granting the agent a direct authority to conclude the contract. What they would do is they would ask the agent to finalize all the terms of the contract with the customer, and the non-resident principal would just finalize that contract and sign that contract. So what it will appear is that the agent is doing all the terms of the contract. He's negotiating the price, he's deciding the price, he's finalizing everything. But he's just not signing the contract. Signing of contract takes place outside India by non-resident principal. In that way, they were able to come out of this business connection definition. The non-resident was telling to the tax authorities that, look, I do not have dependent agent because the agent is not concluding the contracts directly. He does not have the authority to conclude contracts directly. So Indian government amended the definition of dependent agent and said, even if the agent does not have the authority to conclude contracts, but he plays the principal role leading to the conclusion of contract. He does everything to lead the conclusion of contract, and the non-resident party is just concluding the contract, but agent is doing everything else. Then also he would be treated as dependent agent. Clear? Then also he would be treated as dependent agent. Clear? And next is, he has no such authority to conclude contract, but habitually maintains in India a stock of goods from which he regularly delivers the goods on behalf of non-resident. So he does not conclude the contract, but he is maintaining the stock of goods on behalf of non-resident, from which he is regularly delivering the goods also. Right? So in that case also he would be considered as dependent agent. Clear? So if we say, for example, there are these stores of Nike, they maintain the stock of goods in India for non-resident. These are all franchisee, and from which they regularly deliver the goods on behalf of non-resident. They will constitute the P of they will constitute the business connection of non-resident. Clear? Or habitually secures the orders mainly or wholly for non-resident. Meaning what? That if the agent secures the orders from the customers mainly or wholly for non-resident, it should not be the case that he is providing these services to many other people. If he is providing mainly or wholly, as in 90% of times he is providing or these services of securing the order for only one non-resident, then in that case he would be considered as dependent agent of that non-resident, and he would constitute the business connection of a non-resident in India. Clear? Now, who is not considered as dependent agent? Who is not considered as dependent agent? Does not include broker, general commission agent, or any agent acting in ordinary course of business and is of independent status. So one who is not a dependent agent, who is not a dependent agent, one who is very much independent. That is one who does this activity for many people. It's not that he is doing only for one person, right? And he is acting in the ordinary course of business, meaning thereby what? That he is providing these services for many principals and not just for one principal. He's not dependent on one person for carrying on his business. In that case, independent agent will not be said to constitute a business connection in India. Are you clear? Are you clear up till now? Any doubt do you have? Any doubt you can ask now? With a yes, it will cover intermediary agent also if he is very much independent. The conditions for independence are that he should be not working only for one principal. He is acting in the ordinary course of business. Raghuram, I'll explain it at the end of the class. Your doubt, because it relates to the last class, I'll explain you again. Lakshmi, I'll explain you again about the transition period at the end of it. Sandeep, you can watch the recordings available on YouTube. No doubts? Okay. So this is what is included, right? This is what is being included. Now we come to the exclusion part of it. Now we come to the exclusion part of it. And what is excluded is, let's see, purchase for the purpose of export. So operations which are confined to purchase for the purpose of export. These are the inclusions I am talking about. Now, what is excluded is purchase for the purpose of export, meaning thereby that if a non-resident is carrying on the operations only for purchase of goods in India and which he is exporting it to outside India, that will not be covered under the term business connection. Clear? So that will not be included in the term business connection. Second, what is excluded is business of running a news agency or publishing a newspaper if activities are confined to collection of news for transmission outside India. If the activities are only confined to collection of news in India for transmission of the news outside India in case of a news agency, then that will not be included under the term business connection. Clear? Third is operations which are confined to shooting of a cinematograph film in India in case of a non-resident being individual who is not a citizen of India, a firm which does not have any partner who is citizen or resident of India, a company which does not have any shareholder who is resident or citizen of India. So if there are operations which are confined to shooting of a film in India, again, those will not be included in the term business connection. These are some specific exemptions granted to these kind of businesses specifically. Foreign company engaged in the business of mining of diamonds. The activities confined to the display of uncut and unassorted diamonds in any special zone notified by central government. Again, that will not be included in the term business connection. Clear? Any doubt? Any doubt do you have? Okay. Now we move to another very important concept. Liaison office. Now, what is a liaison office? Liaison office are usually the intermediary offices, the communication links they serve as. What they do is they collect the information from the Indian market. These are especially the offices set up for collecting the information or doing market survey, right? And providing that information to the foreign company to start up a business in India or to carry on the business in India. So they serve as only a link, a communication link, and they are specially set up for collection of information to understand the market of any country. So liaison offices maintained solely for carrying on these preparatory activities, preparatory and auxiliary activities, meaning only for collection of information of the market or doing market research of that country, and not undertaking any commercial, trading or industrial activity will not constitute business connection in India. The reason for that is because they are not doing any business, they are just collecting information. They are just doing market survey. So no profits are attributable to these operations because a business is not being carried out by them. And therefore, they will not constitute the business connection in India. Is it clear? Next, significant economic presence. Now, what is this? As I said, business connection includes two parts: dependent agent, significant economic presence. Now, what is the significant economic presence? This term has been introduced under the Income Tax Act very recently. And it has not become operational as yet because a notification is yet to be issued for this. Why is this term introduced and what this really means? So, all of these companies, Google, Amazon, Facebook, all these companies are doing the digital business in India. Now, the earlier term business connection required some physical connection to be existing in India, like having a store in India, having a dependent agent, a person in India who is carrying out the operations, having some employees performing the functions in India. But because these digital companies like Google, Facebook, Amazon, they do not require really any physical place of business, right? They can very well perform the business without any physical place of location in India. They may have a place of location outside India. They may just set up a website in India from where, or an app in India from where you can place the orders and these orders would get delivered at your home. They may just have a warehouse in India, or even if not a warehouse, they can just tie up with the local sellers, take the product from them and deliver it at your end. They only have this website. In that case, India was losing out a large chunk of revenue because these companies were carrying on the business in India but still not falling under the definition of business connection. Because as I said, business connection required a physical presence and these companies did not have any physical presence. So therefore, this concept of significant economic presence was introduced. What does it say? That a company, these digital companies, having a significant economic presence, though not physical presence, they are having some economic presence. It is defined what is a significant economic presence. But if they have significant economic presence, then they will constitute having business connection in India and their profits will be taxable in India. Is it clear? Now, what is significant economic presence? Transaction in respect of any goods, services, or property carried out by a non-resident with any person resident in India, including provision of download of data or software in India, if the aggregate of payments arising from the transaction during the previous year exceeds prescribed amount. So what is a significant economic presence? It says when a non-resident has any transaction, be it related to goods, services, or property, with any person resident in India, any transaction in respect of goods, including the provision of download of data or software. So if you download some data or you provide some software, that will be considered as falling under significant economic presence. If the aggregate of payments arising from that transaction exceeds the prescribed amount, the amount is not yet prescribed. The amount is not yet prescribed. Hence, I said its provision is just put in place but is not yet operational because no notification is issued. Second, systematic and continuous soliciting of business activities or engaging in interaction with such prescribed number of users in India. What does this mean? That if a non-resident engages in interaction with users in India on an app, or it continuously and systematically does business activities with number of users in India, the number of users are not yet prescribed, then that non-resident would said to be having a significant economic presence in India. Is it clear? This is irrespective of the fact that whether the transaction is entered into India, the agreement is entered into India, the non-resident does not have any place of business in India, and even if non-resident does not render physically the services in India. Even if everything happens outside India, if he has a transaction with a resident person in India, then there will be a significant economic presence. Clear? Now, again, not the entire amount from this transaction will be taxable in India, only the amount which is attributable to the Indian operations will be taxable in India. Because the amount could be attributable to different operations, to the purchase, to the sale, to the marketing. But even India will have a right to it because India is providing a customer base to these kind of digital companies. So therefore, the amount attributable to Indian operations will only be taxable in India. Are you clear? Are you clear? doubt till now? Any doubts? Okay. So now, since this Finance Act 2020 has introduced one more amendment to this particular provision. What amendment they have introduced? They say that income attributable to the operations carried on in India shall include the income attributable to the operations carried on in India will also include what? Income from advertisements. Income from advertisement which targets a customer who resides in India or a customer who accesses the advertisement through internet protocol address located in India. What does this mean? So here they do not say, understand the difference. Here they do not say that income from advertisement will constitute the business connection in India or will constitute a significant economic presence in India. They do not say that. Here they say that the income from this significant economic presence or a business connection, when it is constituted in India, as I said, only the income which is attributable to Indian operations will be taxed in India. They say the income which is attributable to Indian operations will include the entire amount of income which is generated through advertisements, What kind of advertisements? So Google usually earns the income. The revenue model of Google is what? Google usually earns the income through advertisements. So when you go to Google, you type certain thing. Like say for example, you say international tax classes. There would be many people whose classes name would be appearing on Google as a search result, right? How this search result appears first or second, or how does it appear? So these advertisers pay to Google for providing their name as a search result under the search results, right? So all these advertisement which targets a customer who is resident in India or a customer who accesses this advertisement, even if the customer is not resident in India, but who accesses the advertisement through Indian IP. So if I go to any website and if there are advertisements located at the right hand side of that particular website, then even if I'm a non-resident, but if that IP is Indian IP, in that case, what will happen? That particular advertisement income to the Google is taxable in India. Second, sale of data collected from a person who resides in India or from a person who uses IP address located in India. What does this mean? Now, Google, how does it decide? If you see, the ads are given generally. Now, how does the Google decide which ads you want to see? Or sometimes you go on Facebook and Instagram, there you see ads, product sponsored ad, right? How does the Facebook know you were searching for shoes? Facebook collects your data. Nothing comes for free. Understand that one thing very clearly. So if you feel Facebook is giving you a free app, you are wrong. How is Facebook generating so much revenue? Facebook collects your data. When you log in or sign up for Facebook, you agree that you will share your personal data to Facebook. Now, Facebook will collect that data. It will sell that data to advertisers. It will sell that data to advertisers and generate the revenue. Now, advertisers, they will analyze this data, and based on that, they will pay again to Facebook to list their advertisement based on my user preference or search preference, right? So sale of data collected from a person who is resident in India or a person who accesses Indian protocol, Indian internet protocol, will also be taxable in India. Clear? Sale of goods or services using data collected from a person who resides in India or from a person who uses IP in India. So if a person is selling the goods or services to me based on the data which they have collected from Facebook, based on my search preferences, the Facebook which it collected the data, that will also be taxable in India. Are you clear? Any doubts till now? Any doubts? If you have any doubts, you can ask now, or we move to another important concept. Are you clear with this particular provision? Or I can give you the sums to solve, few case studies to solve. Any doubts? Okay, so let me give you some questions to solve. And I'll need your answers then. You have to determine whether there exists a business connection in following cases. ABC Limited, a company a resident in UAE, has set up liaison office in Mumbai to receive trade inquiries from customers in India. The work of liaison office is not only restricted to forwarding contracts on behalf of ABC Limited, but it also negotiates and enters into contracts on behalf of ABC with the customers in India. Whether there is a business connection in India or not. What do you think? Give me the answers in your chat boxes. What do you think is the answer? Whether there is business connection in India or not? What do you think? Correct, Nivedita? Yes, Anush. Yes, right, Aman. Mohammed, right? Yes, Mridula, right? What is the answer? Yes, it does have a business connection in India because it is concluding the contract. It is negotiating the contract on behalf of the non-resident, and therefore, in this case, it will be considered as a dependent agent in India. Are you clear? Correct. So we'll do a next two more case studies. What will be the answer for this? A resident of US has set up branch in Hyderabad for purchase of raw materials for manufacturing. The branch is also engaged in selling products manufactured by XYZ. Sales related services. Okay. Okay, now I'm live. Okay. So students, I think there was some issue. I'll repeat the question. For the last question, I gave the answer that purchase of raw materials was not just restricted for the purpose of export. There was also selling of goods and after sales service provided. So in the second question, there was a business connection in India. The third question is in front of you on the screen. Mr. Rajesh, a resident in India and based at Delhi, is appointed as an agent of PQR INC for tracking Indian markets. He canvassed the orders and then communicated to PQR INC. He had no authority to accept the orders. All orders were directly received and accepted by PQR. Delivery of goods was given outside by PQR. No purchase of raw material or manufacturing of finished goods took place in India. Agent was entitled to commission on sale. What do you think is the answer for this? Whether there is business connection? What do you think? Whether there is business connection in India? Okay, I'll repeat the second question as well. And Nivedita, I'll repeat it. Third question is on the screen. First, give me the answer for third and then we'll again discuss the second question. What do you think for the third question, Nivedita? Ambika, reason? Chavi, reason? Why do you say so? Please give me reason. Why, Mohammed? Why do you say so? Raghuram, please give me the reason. Deepa, right? Dhanush, not totally correct. Dhanush, no, the answer is not correct. I'm not finding the reason correct, Chavi. Pooja, yes. Nivedita, yes. Ambika, yes. Kunal, why you are saying? Give me the reason, Kunal. Yes, Mohammed. Hema, reason? See, telling whether there is a business connection or not is one part of the answer, but you need to say in exam like why. The reason is more important and more weightage of marks would be on the reason. Nivedita, yes. So the correct reason for this would be that Mr. Rajesh is not securing the orders and he's not even concluding the contract, nor he's playing the principal role leading to conclusion of contracts. And mere canvassing of orders does not tantamount to securing the orders. So mere, this is very important to mention, mere canvassing of orders does not tantamount to securing orders. Therefore, there is no business connection. Clear? Are you clear? You got the reason? Harish, can you explain how he plays the principal role leading to conclusion of contract? Nivedita, I told you about this. I told you how to write the reason, that he neither secures the order nor he plays a principal role leading to conclusion of contract. Mere canvassing does not tend to securing of order. This is how you have to present it. And therefore, there is no business connection as per section 911. Clear, Nivedita? Harish, how do you say that he is playing a principal role? Harish, how do you say that? Kunal, canvassing would mean that he's trying to do a kind of advertisement, contacting with the customer, but he's not securing the order for him. He's just trying to engage in kind of a marketing function. He's not doing something which is leading to the securing of orders. Securing of orders would mean that he is finally getting some contracts for the non-resident. Clear, Kunal? Okay. So are you clear with this entire concept of business connection? We saw about the dependent agent. How a dependent agent can lead to business connection even if he does not conclude the contract. But if, say for example, he does not sign the contract, but if, say for example, he goes to the customer, he discusses the prices with him, he says to the customer that, look, I'll negotiate with you the price. It will be at best, say for example, instead of 100, which is the market price, it will be at best 80. This is the discount which we can offer. Now, he discusses everything with the customer and asks the customer to place the final order with the non-resident. Non-resident would just send the final order and based on the price negotiated by the agent, which is rupees 80. Non-resident will not interfere in deciding that whether 80 is the correct price or not. That much authority is given to the agent itself. Whatever agent says, non-resident will say yes, and they will sign the contract and send it to the deliver the product to the customer. So here the agent is playing an important role. He's playing a principal role leading to conclusion of contract. Non-resident are just merely signing the contract. Even in that case, the business connection will be constituted in India. Clear? We saw what is significant economic presence when there is engaged interaction with users, provision of download of data, transaction in respect of goods or services with respect to these digital companies. What has been added by Finance Act 2020 are the three things. Income from advertisements. Income from advertisements which are accessed by the Indian resident, right? Which targets a customer who resides in India or a customer who accesses the Indian Internet Protocol, right? Or sale of data collected from a person who is resident in India or who accesses Indian IP. Sale of goods or services using the data collected from a person who is resident in India or person accessing Indian IP. Clear? So what are the examples of that? A question could be targeted on that. When do I say that income from advertisement? So Google generally earns from advertisers. Google has a program wherein they sign up with these sellers who want to advertise. Now these seller, Google does what? They collect the information from so many users who are using the Google. They collect my search preferences and sell that data to the advertisers. These advertisers will have the preference whether they want to list their product at the top of the search result, right? Whether they want their website to be listed as first. What will be the keywords when I will put that the search result will pop up? So advertisers can give all those preferences to Google, and that's the income of Google, right? So if that income Google earns through advertisement, which is targeting me, which is targeting Indian customer, right? In that case, that advertisement income will be taxable in India. Or if the Google is selling the Indian person's data, then also that income from the sale of data will be taxable in India. Why these are very taxable in India? Because here a person who is resident in India, their data are being collected and sold outside India. So this was not there under Act, and because of which what happened? Google was collecting so much of data, Facebook was collecting so much of data, and they were not paying any taxes on the sale of goods being made in India finally, or they were earning a huge chunk of revenue from the data being collected from Indian person and they were being sold outside India, because the business connection definition never included this income to be taxed in India. It does not require any physical presence. If you see what is happening is, here the advertisement income is getting generated from the data which is collected from Indian person, right? So lot of users are using. India is one of the country where there is largest usage of Facebook, Google and Amazon. They are collecting a huge chunk of data, but they are not paying any taxes because they are not directly doing something. They are not directly generating revenue from India. They are generating revenue outside India by making sale to other people who may not be directly selling the goods in India, who may not be having any business connection in India, right? So the income from sale of advertisement, income from advertisement or income from sale of data or income from sale of goods using this data collected will be taxable in India. Clear? Any doubts? Yes, Raghuram, Rajesh is acting only as a commission agent. No, Harish, now did you get what I meant? Aman, I didn't get your query properly. Mridula, not all brokers are excluded. If they are dependent in nature, they will be included. Perfect, Harish. Any doubt with this last concept which I taught you, advertisement income, or is it perfectly clear? Dhanush, I didn't get your question. Rajesh is independently acting for PQR, so he will be dependent agent. I didn't get your question properly, Dhanush. Sandeep, you will have to see my earlier lectures. But anyway, Sandeep, not much is connected because in the earlier class, I taught about residential status, and in this class, I'm taking up this accrual concept, deemed accrual concept. But you'll have to see my earlier lectures on YouTube. Yes, Aman, the transaction between the customer and PQR would not be taxable because there is no business connection then. Business connection would have been there if there was a dependent agent, right? If there is no business connection established and maybe one-off transaction, then in that case, no income would be taxable. But if, say, for example, there are many transactions being carried out, but that person is not only coming directly, he's doing everything outside India. So then nothing will become taxable if there is no business connection, Aman. Raghuram, this Google tax, there would be a separate lecture for that, equalization levy. But it is different from income tax. Kunal, if we sell data of Indian customer to outside India, then it will cover under business connection. That's what the amendment says. If you sell the data of Indian customer, that will be included under the term business connection. And the income would be taxable in India. Shalini, I gave you the conditions to check the dependency of agent, whether he is habitually concluding the contract, whether he's playing the principal role leading to conclusion of contract, whether he's maintaining the stock and delivering the goods from that, whether he is securing the orders or mainly or wholly for non-resident. Clear, Shalini? Ambika, in which context you are asking? Are you asking for significant economic presence, systematic? Aman, commission to agent would definitely be taxable. Because commission agent is an Indian resident and whatever income he gets, that will be taxable in India. A resident's global income is taxable. Raghuram, it's 15 to 20 marks. This chapter has a very important weightage. Yes, Aman. But in this case, if you see, Aman, the delivery of goods was also happening outside India, right? So the business connection would not have happened in India because in this case, the delivery was outside India. All the orders were secured outside India. So there was no business connection being established in India in this case. Clear, Aman? Ambika, systematic would mean that if there is a continuous activity which is being carried out through engagement with the users, which is what the digital companies generally do. They on a continuous basis and systematically in the way that in an organized way they are doing a business through engagement with the users, and that is how they would fall under significant economic presence. Clear, Ambika? Aman, is it clear now? Yes, Pooja, if the same case would have happened in India, the last example which we discussed, and the sale was made in India, then absolutely even without agent, there could have been business connection in India. Clear, Pooja? Okay, Kunal, I will do that. I had already done that, but I'll again. Any other doubt? Perfect, Aman. Okay, Pooja. Ambika, is it clear? Okay, so we take a break. Those who wanted to copy the second example can do that. This XYZ example, if at all it is missed, the answer for that was that there is a business connection in this case. Yes, there is a business connection as branch is not restricted to purchase of goods but also does sale function. Therefore, the exclusion to section 911 not apply. Which exclusion? Of purchase of goods for export. So those who have not copied the second example can copy it now. Shall we start? Yeah. So there's one doubt asked. Aman, in example 2, you're asking if sale is made by the authority outside India and branch does only marketing function, would it be taxable? Answer is no, Aman. If there is no authority to conclude contract, if there is sale outside India, then it will not be taxable. Clear, Aman? Okay. So now we proceed to another very important part of section 911, which is indirect transfer. Now this is very, very, very important. Now what is this? Let's understand very clearly. In this particular case, I'll explain you by example. There was this one very landmark judgment of Vodafone, based on which this section has been introduced. Now, what was this particular provision? Just give me one moment. Yeah, sorry. So, section 911 was based on Vodafone case, this indirect transfer provision specifically. Now, what happened in this case? There was this Hutchinson Hong Kong company, a company incorporated in Hong Kong. It had series of web of companies in between, through which it hold Hutch Cayman Island company, which in turn held Hutch Mauritius. Right? Now, this Mauritius company, again through series of investments, had only one company in its balance sheet, had only one asset basically, and was Hutch SR India. Now, what happened was Hutch wanted to exit out of the Indian market. So it wanted to sell the Indian company to the buyer, which was Vodafone. Right? Now this Vodafone at that point in time wanted to enter into Indian market. Hutch asked its tax advisor how we can exit with the minimal liability. The tax advisors advised them that if you directly sell the Indian business to Vodafone, what will happen is there was no tax treaty, double tax avoidance agreement at that point in time between Hong Kong and India. Resultant, what would have happened? The entire capital gains would have been taxable in India. Why? Because any income out of transfer of capital asset located in India would have been deemed to accrue or arise in India. Correct? So what cleverly Hutch did is, it sold this Mauritius company. It sold this Mauritius company to Vodafone. Indirectly, what happened was the sale was of Indian company, because this Mauritius company had share capital and investment in Hutch India. That's it. So indirectly, by selling off this Mauritius company, Hutch sold the Indian company. Entire transaction took place outside India. The shares of Mauritius company were sold to Vodafone. Consideration was received in foreign currency. Buyer was a non-resident. Seller was a non-resident. The entire transaction was carried out outside India. The Indian tax authorities did not like this transaction. They found this transaction very suspicious. They thought that Vodafone, just sitting outside India, was able to enter into Indian market through this Mauritius company. So what they did is they challenged this transaction and they said this transaction was not in accordance with section 911. This should have been taxable in India. The matter went before the Supreme Court. Supreme Court said there is nothing under section 911. What does section 911 says? That when a transfer of a capital asset situated in India, only then you will have income deemed to accrue or arise in India. There is nothing under section 911 which provides for such indirect transfer, right? Vodafone clearly won the matter before the Supreme Court, but as the government was not happy with the Supreme Court decision, they made a retrospective amendment. Since 1961, this amendment was carried out. And this indirect transfer provision was brought in under the Indian Income Tax Act to cover up this transaction. Now, what is this indirect transfer provision? Let's understand this in detail. So, what does this provision say? What does this provision say? Let's understand that if asset or capital asset of this intermediary company, Hutch Mauritius, I'm saying Hutch Mauritius. Now you will ask me why they sold the Mauritius company share instead of directly selling the Indian company share. Because the tax treaty, the double tax avoidance agreement between Mauritius and India was very favorable. Mauritius never taxes capital gain under its tax law. Also, the Mauritius-India double tax avoidance agreement did not allow India to tax the capital gain on sale of shares. Right? So, Mauritius-India double tax treaty was very, very favorable at that point in time. The Mauritius company's shares were sold because the Mauritius does not charge tax on capital gain. That's why Mauritius was chosen and the Mauritius company's share was sold. Clear? So, capital asset, which is Hutch Mauritius, the share or interest in a company, I would term this capital asset is share or interest in a company incorporated outside India. Incorporated outside India. If it derives value from, if it derives value from directly or indirectly, value substantially from assets located in India. So if share or interest in a company incorporated outside India, in our case it is Hutch Mauritius, derives directly or indirectly value substantially from assets located in India, in that particular case, what will happen is this particular capital asset, the share or interest in a company incorporated outside India, would be deemed to be situated in India. deemed to be situated in India. Are you getting this? So if share of a company incorporated outside India is deriving value substantially from assets located in India, then this particular company's share would be deemed to be located in India. What will be the effect of that? If it is deemed to be located in India, what will happen is that this particular transaction then would be considered as taking place in India, and the income from that would be deemed to accrue or arise in India. Because what will happen is, as per section 911, we discussed what? That transfer of a capital asset situated in India will be covered under the term business connection, right? This transfer of capital assets situated in India. Now, the share of Mauritius company is not situated in India. But if the shares of Mauritius company derives value directly or indirectly, substantially from the Indian assets, then the shares of Mauritius company will be deemed to be situated in India, and it will be considered as transfer of capital assets situated in India. Clear? Because once you say that asset is deemed to be in India, meaning the income from that transfer of asset will be taxable in India. Are you clear? Now, when do we say the value is derived substantially from assets located in India? What is the meaning of term substantially? What is the meaning of that? So for that, it says substantially means value of Indian assets. First is the asset test. Value of the shares of a foreign company will be deriving its value from assets located in India if value of Indian assets as on specified date, value of Indian assets as on the specified date. What is specified date? We will see. Exceeds rupees 10 crore and exceeds rupees 10 crore and represents at least 50% of value of all assets owned by foreign company. Clear? So when do you say that the value of shares of foreign company derive value substantially from value of Indian assets if as on the specified date, value of Indian assets exceeds rupees 10 crore and represents at least 50% of value of all assets owned by foreign company. Clear? Now, what do I mean by the value? What is the value? Whether it is book value, whether it is market value, what is the value? Value means value of assets mean FMV of all assets as on specified date without reduction of liabilities. without reduction of liabilities. So it means FMV. Now FMV as on which date? The value of assets as on which date we have to take. For that, the specified date means, what is the specified date? Let's understand. The Act says specified date means book value. Specified date means, specified date means date on which accounting period ends before date of transfer. Date on which accounting period ends before the date of transfer, or date of transfer if book value of assets of company as on date of transfer is greater than book value of assets as on last date of accounting period by 15%. Book value of assets of company as on the date of transfer exceeds the book value of assets as on the last day of accounting period by 15%. So how will you determine the specified date? If I have to simplify this, you need to check if the book value on date of transfer exceeds 15% by book value on last date of accounting period. If the answer is yes, then you will have to take date of transfer. If the answer is no, then you need to take date on which accounting period ends. Are you clear? So what does this mean? I'll again summarize it completely. It means that if we say that a share of a foreign company, when it will be said that it is deemed to be located in India, if the share of the foreign company derives value substantially from assets located in India. How do you determine whether it derives substantially from assets located in India? If the value of Indian assets as on specified date, value means FMV. FMV as on the specified date, and it's a cumulative condition, represents at least 50% of value of all assets owned by foreign company. FMV of Indian assets represents at least 50% of FMV of all assets owned by foreign company. So value here means what? FMV. Value here means what? FMV. Now FMV as on which date is to be taken up? You go step 2. FMV as on taken up, you go step 2, which is specified date. So what is the specified date? You will first find out whether the book value on the date of transfer exceeds 15% on the book value on the last date of accounting period. For determining the specified date, you need to take into consideration the book value on the date of transfer, whether it exceeds 15% of the book value on the date of accounting period. If the answer is yes, you have to take FMV on the date of transfer. If the answer is no, you have to take the FMV on the date on which accounting period ends. So first you need to identify specified date. For specified date, you have to consider book values. Once you know the specified date, then finding whether the value of shares derived their sub-value substantially from Indian assets, you need to take FMV. Is it clear? Any doubts till now? Any doubts do you have? If you have any doubts, you can just tell me here. Vodafone is from Netherlands, Sandeep. Vodafone was buyer. Thanks, Arshad. Any doubts? Okay. So now that we know how to determine the value, the FMV for different kind of assets are given under rules. Are given under Rule 11UB, which specifies the determination of FMV. How do you determine the fair market value of that asset? There are different procedures given for different kind of assets which are given under Rule 11UB. Okay, so this is what I have listed here. Like for example, shares of a listed company, listed Indian company. How will it determine the FMV? It is given as based on the market capitalization method. So A plus B divided by C. Market capitalization of Indian company plus book value of liabilities divided by total number of outstanding shares. Then share of listed company which is listed as on the specified word in part 1, which are not having the management or control interest. In that case, FMV is equal to observable price. So for different assets, different methods are given for FMV, which we are not looking much into detail because this is not clearly covered under paper 7 in much detail, but under paper 6C. But that then too also I have listed here the different methods of computing FMV, which could be maybe important from MCQ point of view. When I say that the value of the Indian asset is derived, the shares of a foreign company assets. Now, company will be taxable in India. Not all. Only the income attributable to indirect transfer of assets will be taxable in India. Because understand one thing, in Vodafone's case, Hutch Mauritius investment was the only asset of Hutch Mauritius was Indian investment. In that case, the entire income would have been taxable in India. But here there could be a possibility that the company might have some other assets also. So in that case, some of the income might be taxable in Mauritius and only part of income might be taxable in India. So how do you determine the capital gain attributable to be taxed in India? In that case, you have a formula. A into B divided by C. A is income of shares, capital gain. B is FMV of Indian assets as on the specified date. And C is FMV of assets of the company or entity as on the specified date. So A is the indirect transfer income B is the FMV of Indian assets divided by the FMV of total global assets of that Mauritius company. So only the income attributable to the shares, the value of shares which are derived from Indian assets will only be taxable in India. Is it clear? Is it clear? Now, there are certain exceptions being given to indirect transfer of assets. What are those exceptions? Let's understand. So, above rule is not applicable to investments held directly or indirectly in category 1 foreign portfolio investor. Now, what does this mean? So, say for example, what are the foreign portfolio investors? So, these are kind of large number of investors. They are trust who basically invest in Indian stock exchange, right? So, say for example, here it was a Mauritius company. But understand, these foreign portfolio investors make investments in Indian stock market. Foreign portfolio investors, these are usually trusts which collect the money from group of investors and they trade in Indian stock exchange. These are portfolio investors, meaning they do not have substantial investments in a company. They do not have management control in a company like it was in the case of Hutch. Hutch had a management stake in Hutch India. Here they just trade in stock exchange. Now this foreign portfolio investors. So if say for example there are number of investors who invest in this foreign portfolio investor company who in turn trade in Indian stock exchange. Now, when this foreign portfolio investor will sell the shares, say of Reliance, the capital gain will be taxable in India because it is a sale, income derived from sale of Indian asset, right? There is no indirect transfer provision applicable because it's a direct sale, right? But when these investors who are making investment in this foreign portfolio investor company, right? This trust, which may be located in Mauritius. And then there are US investors who are investing in this Mauritius company. When they will sell the shares in this particular company, indirect transfer provision will apply to them. But this was not the intention of indirect transfer provision. Why? Because they do not have the intention to gain the benefit from indirect transfer provision. They are just trading in stock exchange. They are not having any management right or control. Their intention was never to, indirectly sell the Indian asset. They are always making investment in this, and these investors, the portfolio investment companies, are making investment in different assets. So when these investors sell the investment in the foreign portfolio investor company, indirect transfer provision will not be applicable to them. This is exception 1. So investment by a non-resident in foreign portfolio investment company will not attract indirect transfer provision. Is it clear? Is it clear? The second exception is in the case of similarly venture capital companies. Venture capital companies. Now these venture capital undertakings, when they will sell the shares of the Indian companies, again capital gain would be attractive because it will be a direct sale, right? It will be a direct sale of Indian asset. But when investors of the venture capital undertakings, when they will, have a buyback, when this venture capital company, say for example, it issues the buyback offer for its investor, or for that matter, these investors redeem their investments, then in that case, indirect transfer provision will not be attracted. That is exception number 2. Clear? So when income arising on account of redemption or buyback of securities held in India by the specified funds will not attract the indirect provision. Clear? Is it clear? The third exception is if a non-resident transfers, right? If a non-resident transfers outside India any share in a company situated outside India or incorporated outside India, if the transferor does not hold at any time during 12 months preceding date of transfer right of management or control and voting power greater than 5% of total voting power in foreign company. So if small investors are there, right? There could be some small investors who are not having any management or control right in the foreign company and their voting power is less than 5% of total voting power, or the share capital is less than 5%. Then in that case, indirect transfer will not apply to such small investors. Clear? This is because the indirect transfer provision was targeted on companies which had the management right and which were trying to avoid the taxes in India. Clear? So is it clear till now? Any doubt do you have? Any doubts? Because all assets. Raghuram, all assets owned by foreign company means the Mauritius company's asset. We are looking at the Mauritius company's share, which we say are deemed to be situated in India. What is transferred is the Mauritius company's share and not all the group companies' share. Any other doubt? Okay. So we can solve a sum based on this, but just last one important point on this indirect transfer, because solving a sum will give you a lot of clarity. So understand one thing. When I say that this Hutch Mauritius, the share of Hutch Mauritius is now deemed to be located in India because it derives the value substantially from Indian assets, right? So now the question arises, when this Hutch company will declare the dividend will declare the dividend to its shareholder, right? In that case, whether that dividend can also be taxed in India. Because what we are saying is the shares will be deemed to be situated in India. And therefore, the question arises whether the dividend on those shares would also be taxable in India. So the Act provides a clear clarification against that the declaration of dividend by a foreign company outside India does not have the effect of transfer of any underlying assets located in India. So therefore, there is no transfer of asset because of dividend being declared. And therefore, the CBDT has issued the clarification that dividends declared and paid by a foreign company outside India in respect of shares which derive their value substantially from India would not be deemed to be income accruing or arising in India. Clear? Is it clear? So can we solve sums on this? Harshad, there can be many layers under indirect transfer provision. Okay, so let's solve the sums based on this. I'll solve one sum for you and then you are supposed to tell me the answers for the rest of it. Fubon, a company incorporated in Mauritius is a wholly owned subsidiary of Fubon Inc. UK. Fubon UK enters into a share transfer agreement with Fubon Fist PT, a Singapore company, to transfer the shares of its subsidiary Fubon Mauritius. The agreement has been entered in UK. Fist Singapore has provided the sale consideration in Singaporean dollars from Singapore bank account. Fubon Mauritius has provided following information of its tangible or intangible assets. Particulars. I'm giving you three situations. Situation 1, situation 2, and situation 3. Date of transfer 25th June 2020. Last date of accounting period of Fubon Mauritius 31st December 2019. Right? Book value of assets of Fubon Mauritius as on 25th June 2020. Located in India, 56 crore, 57 crore, rupees 10 crore. Located outside India, rupees 58 crore, 59 crore, and rupees 8 crores. Book value of assets of Fubon Mauritius on December 31st, 2019. Located in India, rupees 60 crore, rupees 60 crore, and rupees 11 crore. Located outside India, rupees 40 crore, rupees 40 crores, and rupees 4 crore. Right? Fubon Mauritius has liabilities which are situated in India and outside India and are included in above figures. And are included in above figures. As in, you need not exclude the value of liabilities because there is no reduction there. Or I can write or are excluded from above figures, so that you don't need to reduce it then. There is Fubon UK owns more than 5% shares in Fubon Mauritius during 12 months before transfer. During 12 months before the transfer. However, it does not hold right of management or control. Assume book value of assets is same as fair market value. Determine the capital gain. Determine whether the capital gain arises on sale of shares of Fubon Mauritius is taxable in India. So I give you 2-3 minutes time. See if you can solve it by yourself, or otherwise I'll take up the first situation for you. Apply the questions I have taught you now and see if you are able to get to the answer. What you will have to do is, the first thing what you will first have the specified date. Let's try. What will the specified date according to you? First tell me that in the situation 1. Date situation 1. The answer for that. We go step by step. What will be the specified date? What you will have to compare for the specified date? Book value of the global assets of Mauritius company. Book value of the global assets of Mauritius company as on the last date of accounting year and as on the date of transfer, whether it is more than 15%. So what will be the specified date? Any answers? Dhanush, correct. So Dhanush, can you tell me whether the indirect transfer provision are applicable in this case now that you have got the specified date correct? What do you think, Dhanush, is the specified date? What will be the specified date? No, Ambika. Ambika, can you tell me how did you arrive at this particular date so that I know what mistake I've done? Dhanush, are you able to get the answer whether indirect transfer is applicable or not? Could explain you, don't worry. Harshad, wrong. Harshad, how you arrived at that date? Can you explain? Okay, so let me solve this sum for you so that students can get a clarity. So first step, specified date, right? How did I derive the specified date? Book value Fubon Mauritius on December 31st, 2019. That is last date of accounting year, right? Preceding the date of transfer. What is the global assets we have to consider, right? So what are the global assets as on the last date? 100 crore in situation 1, right? Book value of global assets of Mauritius as on 25th June 2020, which is date of transfer. So you have to take all the assets, Indian as well as outside India, right? So as on 25th June 2020, it is 114 CR. Now start saying if the book value of assets as on the date of transfer exceeds by 15% the book value of the assets as on the date of last date of accounting year. If the answer is yes, then date of transfer. If the answer is no, then it is the last date of accounting year. This is what we discussed, right? So if you see the chart, what did I tell you? If the book value on the date of transfer exceeds 15% of the book value on the date of accounting period. If yes, date of transfer. If no, date on which accounting period ends, right? So whether 2 is greater than 1 by more than 15% of 1. So whether 2 is greater than 1 more than 15% of 1. In situation 1, what is 15% of 1? 15. And the difference between 2 and 1 is 14. So whether 2 is greater than 1 by more than 15, the answer is no. So therefore, it will be last date of accounting period, December 31st, 2019. Clear? Now we go to the step 2. Whether the share of Mauritius company derives value substantially from Indian assets. For determining that, what we Indian assets is more than 10 crore, right? So now you will say fair market value of assets owned in India as on specified date, right? As on specified date. So specified date is 31st December 2019. On that date, what is the FMV? FMV is equal to book value on the year. What is the specified date? 31st December 2019. An asset located in India, the value of which is 60 crores. So it will be 60 crore. And what was the second condition? FMV of Indian assets. FMV of Indian assets date exceeds 50%. All assets, right? Exceed 50% of all assets. So here 60 crore divided by what is the value of all assets on 31st December 2019? What is the value of all assets? 100 crore. So it is 60%. So whether both conditions are satisfied, it is more than 10 crore and FMV of Indian assets is more than 50% of the value FMV of all assets on specified date. Right? So therefore, indirect transfer provision yes, applicable. Clear? Clear? It is applicable. Also, it does not fall under exception because the question says that it owns more than 10% of the value of shares. Exception is when you do not own more than 5% and you do not have management interest or control. So here you do not have management control, but you own more than 5%, therefore it does not fall under exception. Exception, there is and condition, right? And condition there and exception. Exception applies when you do not have right of management or control and voting power is less than 5%. Voting power is less than 5%. So in that particular case, what will happen is here you own more than 5% and even if you do not have management control, still indirect transfer provision will apply because you do not fall. Clear? Clear? What will be the answer for exception for the 2 and 3? What will be the answer for situation 2 and 3? Raghuram, you understood the mistake? Dhanush, yes, correct. Did you understand now? What will be the answer for situation 2 and situation 3? What do you think is the answer for situation 2 and situation 3? Kunal, in the specified date, what you have to consider is book value of the assets, global assets, as on the date of transfer. And value of all the assets as on the last date of accounting year. Whether book value, which is this of all the assets on the date of transfer exceeds by the book value of global assets as on the last date of accounting year by 15% of the last book value as on the last day of accounting year. Clear? So whether 2 is greater than 1 by more than 15% of 1. So in short, 2 minus 1, if it is greater than 15% of 1, it will be the last date of, it will be the date of transfer. If 2 minus 1 is less than 15% of 1, which is in this case, then it will be the last day of accounting year. Clear? Clear, Kunal? Did you understand? Ambika, perfect. And whether indirect transfer is applicable in situation 2, Ambika? Kunal, did you get it now? Perfect. The reason. Kunal, understood, or do you want me to repeat? Guram, you're right for situation 3, but not for situation 2. So, Aman, whether the fictitious assets are included or not, that depends on the valuation methodology which is provided under fair market value rules, as I said, and it is based on actually the market capitalization method. It is based on market capitalization method. Clear, Aman? Perfect, Dhanush. Both the answers are correct. No, Ambika. Situation 3, the answer is not correct. For situation 2. Please attempt to give me the answers even though it is wrong. Is then only you will get a comfort. See, in situation 2, again, book value of assets remain the same as on the last day of accounting year. What is it? 100 crores. In situation 3, it is 15 crores. Book value of global assets as on the date of transfer is 116 crore in situation 2 and it is 18 crore in situation 3. Now in situation 2, whether 2 minus 1 is how much? 16. 2 minus 1 is 16. And if you see the 15% of 1, which is the last date of accounting year, the book value on that date is 15, right? So whether 2 is greater than 1 by more than 15% of 1, the answer is yes. The answer is yes. That means the book value assets as on the date of transfer exceeds the book value of assets as on the last year of the date of accounting year by more than 15% of the book value of assets as on last date of accounting year. Clear? In that case, it will be date of transfer, which is 25th June 2020. In the third situation, again, what is the difference between both 1 and 2? What difference between 1 and 2? it is 3, right? 2 minus 1 is 3. And if you see 15% of 1 is how much? 2. So whether 2 minus 1 exceeds 15% of 1? Yes. In this case also, it will be 25th June 2020. Now, FMV of assets owned in India as on the specified date is how much? As on 25th June now. How much? It is 57. And it is 10 crore in this case. Clear? So in this particular case, it exceeds 10 crore, and whether it exceeds 50%, so 57 crore divided by what is the value of global assets as on 25th June? It's 116 crore. It comes to 49.14%, which is less than 50%, and therefore indirect transfer provisions are not applicable. So though it exceeds 10 crore, but it does not exceed the 50% of the assets, and therefore indirect transfer provisions are not applicable. Clear? In the last case, it does not exceed only 10 crore. It does not exceed, though it exceeds all the assets. So both the conditions need to be satisfied cumulatively, and therefore an indirect transfer provision is not applicable in the last case also. Are you clear? Are you clear? Deepa, you understood now that FMV is more than 10 crore, but FMV of Indian assets is less than 50% of all assets, and therefore indirect transfer is not applicable. Understood, Deepa? You have given the specified date correctly, right? In this case, FMV and book value are same. It's not different. So the situation is very simpler. So Kunal, accounting date, the last date of accounting year preceding the date of transfer. It means what? The accounting year gets ended before the date of transfer. That accounting date we have to take. So if the date of transfer is 25th June, what will be the last accounting year period? 31st December. So that accounting period we have to take up. The preceding the date of transfer. Understood, Kunal, now? Yes, Raghuram, in situation 2, indirect transfer does not apply. That's what I have said. Is it clear? Perfect, Kunal. Raghuram, clear? I'll give you one more sum to solve. Reliance, in this you have to solve by all yourself. Reliance India Limited is an Indian company. Fubon US, a US incorporated company, wants to get holding in RIL. Fubon US floated a company in Mauritius and acquired the shares of Mauritius company on 1/1/2019 for rupees 10 crore. Or you can write Fubon Inc. acquired shares of a Mauritius company on 1/1/2019 for rupees 10 crore. The Mauritius company made investment in on 1 March 2019, 1st March 2019, or you can write 1st March 2020. Account of Mauritius ends on December 31st. As on December 31st, 2020, value of total assets was on 31st March 2021, Fubon US transferred shares of Mauritius company to a Mauritius company or to an investor in US at price of rupees 50 crore. The book value after reduction of liabilities (31st March 2021) is as below. Mauritius company and RIL. Book value in crores, 30,110. FMV 50,180. Liabilities 0,20. You are required whether indirect transfer provision will be applicable. You are required to determine whether indirect transfer provision will apply to capital gain. Is the sum clear? What will be the answer? First, tell me just whether indirect transfer provision will be applicable in this case or not. Whether indirect transfer applicable? No, Raghuram. First of all, what is the specified date? No, Dhanush. Not the correct answer. Question, Dhanush. No, it's running. Yeah. Shall I give you this sum as homework and shall we discuss it in the next class so that you can apply your mind properly? Kunal, you're right. The specified date is right. So what, whether indirect transfer is applicable? Yes, Deepa, right. Specified date. But whether indirect transfer is applicable? Ambika, right. It is 2021, Ambika. Okay, Ambika. Yes, please go through this entire provision again and then try to discuss with you this entire sum in the next class also, so that you have gone through the provision. Just one hint to make it very simpler for you. Read the first line very correctly. There is 20% investment. That's the only clue I can give you. And then try solving the sum. That 20% investment which is made in Reliance Industry, that percentage is very important for solving this sum. Okay. If there are no further doubts, you can ask me doubts if you have. Otherwise, we'll solve this sum in next class once you are, ready with your answers. So in the next class, I'll first ask answers for this. If you have any doubts, you can ask me. Or Lakshmi, you had one doubt about transition period of the last class. And Raghuram, you had 100% downstream subsidiary doubt. I'll take. Anybody has any doubt with respect to today's lecture? Raghuram, first I'll solve your doubt of the downstream subsidiary. So in that case, Indian company had a subsidiary outside India. So if the subsidiary which was outside India, that had a poem in India, that had poem in India. I'll just open up for you that question. This example, right? So it had a downstream subsidiary and Indian company has a holding company ACO and country X. ACO had other subsidiaries. Downstream subsidiaries means the other subsidiaries. So ACO was ACO was intermediate company and it had companies. Now ACO had only income by way of dividend and interest. Poem of ACO was in India. So the CBDT says that just because ACO's poem was in India does not mean BCO, CCO and DCO will also have poem in India. Their poem will be determined separately. So this means what, Raghuram? There's an Indian company. It has a subsidiary ACO whose poem is in India. ACO has few other subsidiary B, C and D. So just because ACO's poem is in India, the intermediate companies, does not mean B, C and D's will also be in India. Their poem will be determined separately based on guidelines. Clear, Raghuram? Lakshmi, you had doubt with respect to the transition period. I think you were asking about this preparation of balance sheets, right? So as I said, if the period from Jan to December, then you will have to prepare the balance sheet till March 31st because the extended period is less than 6 months. But if say the calendar year in other countries is July to June, then in that case you will prepare from July to March And April to June would be another period because extended period is more than 6 months. Clear, Lakshmi? Ambika, book value is not to be taken net of, book value is to be taken, yes, without liabilities. Yes, Deepa, you are right. Indirect transfer is applicable in that case. Yes, Deepa. But just the percentage, I think, is not correct. Percentage is not correct, Deepa, but answer is correct. Can we stop for today and we can proceed in the next lecture with this sum? You have to also compute the capital gain in this case and the tax thereon. So shall we stop it for here today? Okay, so let's end the lecture here today, and in the next class, I'll discuss this sum again. Thank you all.